you've done very well with uranium for your subscribers and the people who follow you. So let's talk uranium, because I'm looking at all the growth of nuclear in China right now. Well, that's inherent demand for uranium. And there's many other stories. We chronicle it on anytime I see somebody opening up a plant or doing more, investment, I listen to that as a uranium story. So your view on uranium, you're still bullish on it? Is it a wait and see attitude?
No. I'm very bullish. And, if anything, this is a particularly opportune question right now because, in 2023, uranium doubled. We got a real hockey stick. By the way, that was my top call for the year, and I was right.
Mm-hmm.
But they went over $106, right? And it just, real hockey stick. So as we were saying earlier in this conversation, anything, goes vertical like that, you need to start thinking about possible corrections and so on, which I said for 2024, and people got mad at me. But
what a great way to start off the year, getting a chance to talk to Lobo Tiggre. He's the author of the it's independent, but it's due diligence reports. And you can find them at independentspeculator.com. One of the great analysts when you come to what's going on globally, but what's going on, drill down into the commodity markets. The list is a long one there. Lobo, thanks for finding time. Great to have you to start the year.
Happy New Year, Mike, and to the audience and our fellow Puerto Ricans out there.
There you go. Let's start with, I know, just the overview question, though. When you look at the global economy, I'll drill down into some of this, but I'm looking at the weakness in China, for example. I'm looking at the weakness in Europe. These are things that you both forecast and then chronicled as they were happening. Just give me the State of the Union, sort of, when we talk about the global economy.
Sure, but State of the Global Union. I guess the key variable here is the so-called American exceptionalism. The evidence of weakness in the global economy, you just cited a few things. I mean, it is a flood of evidence. And whether it's officially in recession or not, I mean, global GDP, who trusts the people who put up these numbers? But various governments around the world are reporting negative numbers. China, of course, people say, oh, it's enviable to have 4.5%. Well, but that's less than their target. And that is problematic for them politically. Their social compact is we provide, high growth and you don't complain about our dictatorship. Mm-hmm. So there is clearly a lot of trouble around the world. And the one shining beacon on the hill appears to be the United States. My view on this is, well, it's twofold, really. One is if you look beneath the hood, not very far, you don't even have to tinker with the engine, just open the darn hood. You can see all kinds of problems with the U.S. economy, leading indicators, the cracks appearing in the labor market. These are very serious issues. And this is despite wartime levels of deficit spending. So that really is the other point, is that there is actually evidence of weakness in this American exceptionalism story. And the other thing is that this is despite what our friend Lynn Alden calls fiscal dominance. Trillions and trillions of dollars flooding out of Washington. And we still have, at best, lipstick on the pig, as it were. So I'm not going to predict doom and gloom around the corner, Mike, but I do think that it behooves everybody to be cautious about buying into this American exceptionalism narrative, especially with, whether you love him or hate him, everybody knows Trump is an agent of change, if not chaos. And we've got Trump shock inbound. We'll see that, the tariffs are just part of that. So interesting times right ahead of us.
Well, one of the things you just mentioned there has concerned me when we talk about the U.S. growth story, but how much of it was fueled with government spending? How much of it is fueled with the creation of money that, is how real is it? Now, we've seen that in other parts of the world too, but how real is it? And I'm still looking at the huge growth in the debt situation, in the U.S., and they can't afford to have a slowdown. You can't afford to have government receipts.
Wall Street's attitude about this is, who cares? It doesn't matter.
Yeah.
It's growth, right? But we know, and any gold bug or silver bug worth their salt knows that eventually you've got to pay the piper.
Yeah.
But yes, you can charge up the credit card to the limit. And, not coincidentally, credit card defaults spiking are one of these things, one of these signs of trouble with this American exceptionalism story. But yes, actions have consequences. And
what do you take with the Trump presidency now? I mean, there's been, phenomenal, it may be expected, focus on major changes. As you just said, he's an agent of, I love it, both change and chaos. There are worries. And of course, there's so many areas, but I'm talking financially. He certainly doesn't seem to be worried about the debt and deficit issues going on at this point. He's not made any indication that's a concern. Obviously, a major change in they're looking, easier said than done, in government spending, government structure. Just what's your take on that, especially for investors? Is it a wait and see to see what he does, or
yeah,
is there...
Absolutely. And I really like that you put that for investors caveat in there, because let's not get ideological here. If you're a MAGA hat wearer and you love everything Trump does and says, the purpose of this conversation is how do we make money, not to support or detract from Trump. And personally, as a libertarian, anarcho-capitalist type, I love to hear all this talk about slashing government spending and waste and deregulation. I mean, overall, the pro-business agenda, I'm generally in favor of that. As a person looking at the markets, though, and how do we make money, markets don't like change. Yeah. And even if it's favorable change, that moment of inflection can cause problems. The other thing is, as a fiscal conservative, you promise all of these people, everybody, Tom, Dick, and Harry and their cousin gets a tax cut, whether it's waiters and waitresses and tips and overtime and firefighters. I mean, Trump even, it's gobsmacking that a mainstream now person, president-elect, suggested getting rid of the income tax entirely. As a libertarian, I love that idea. But where's the money going to come from? And tariffs are not going to replace that. I'm sorry, that's just not just politically, but it's just not realistic in this time and era. When tariffs funded the government, yes, that did happen. But the government was like 1% of its current size, maybe 2 or 3 at most during wartime. So, I mean, we've got promises. And sorry, but remember, Trump admittedly was a lifelong Democrat until he decided the Republicans would elect him. And we have not just his words, but we have his actions from last time. Last time he was beating up on Powell to lower interest rates. Deficits were okay. Before COVID hit, deficits were up under Trump and spending was up under Trump. So again, I'm not trying to beat up on Trump. I'm looking at the markets and the incoming economic changes. And I'm looking at, blowout deficits, which are highly inflationary, which even if they produce a sugar high in the economy, it's an open question whether the deregulation and the spending cuts and all that will happen or will happen on time to make any difference. Yep. The only certainty is that this is highly inflationary, which I'm sure your audience and mine, gold and silver bugs that we are, we know what to make of that.
Yeah, and that's the part I wanted to come to is that, and clearly, I was talking just a bit earlier, the bond market is indicating they're worried about inflation, because as we've said, the Federal Reserve lowers rates and presto, the bond rates go up and with some significance.
And mortgages too.
Yes. And so I'd assume that the market is, how I should interpret that is the market is saying, well, you know what, you've got a lot of upward inflationary pressure going on here. So it's quite it's quite an environment right now.
Yeah, what's really interesting about this is it's in some ways it's a restoration of normalcy in that the bond market is acting like the grown-ups in the room and saying, yes. hey, wait a minute here. The vigilantes aren't entirely asleep at the switch, right? Whereas the stock market, that's interesting. You could say, well, it's inflationary, so that's good for the market, right? All this easy money from Washington. On the other hand, if it is inflationary and the Fed will be forced to pivot and never mind the rate cuts that have now been snatched off the table for 2025. What if we start looking at not just sticky, but rising inflation and rate hikes before the end of this year? The market is just not just looking through it, it's just ignoring that. I'm not listening sort of reaction as far as I'm concerned. That's a very real possibility, if not probability, that a forward-looking market should be pricing in. I don't think it is yet at all.
Yeah, and I'm glad people should be aware of that level of risk. And I'm going to come back to something we mentioned a moment ago. I'm just using it as an example. It wasn't very long ago that we thought China would be the rescue agent coming out of COVID, that it would be the fuel for a huge rise in commodities. And that I would say that was the consensus view. Well, that hasn't come to... Yeah, yeah. I mean, it just, and in the same way with what you're saying with the interest rates. So people have to put that on their radar and say, you know what, that could be the surprise. That in fact the pressure moves it up. Sorry, I'm over the map with that, but it's important that people realize that these kind of changes to the narrative are out there. And yeah, I'll continue with the U.S. story just for a moment more and come back to China, that because of the commodity impact there. But, you know, as I say, it's the timing, as you just said, you know, how fast, if they're successful with sort of some sort of significant level of restructuring, what period of time? Because the one thing that I'm noticing is the debt just continues to go up. Debt service charges are continuing to go up. That's the certainty in all of this.
Yeah. And that's, it's one of those things that we'll never know unless, some years from now, somebody in the current administration and the next one writes a McNamara style confession book on his deathbed and says, yeah, we were stuck between a rock and a hard place. And this is how it really was. But like now we won't know. But there's a lot of people out there that subscribe to the narrative. And it makes sense to me. We'll never prove this, Mike. But the Fed has to know that the federal budget and its interest rates payments, which exceed military payment, of all the things we're spending money on, is just paying off, not paying down the principal, but just paying the interest on the overcharged credit card, the federal government's overcharged credit card. That is a gobsmacking fact. And for Powell to get up and say, oh yeah, we don't even think about that. That's Congress's purview. I mean, that's silly. They're the guys that are supposed to be managing the economy. And for them to ignore something like that is just not credible. So the rock in the hard place is the Fed has to know that if they do raise interest rates again, that's a problem, as all the short-term paper that the Feds have rolls over and they have to refinance at 2-3 times the rate. That's a huge problem. But if they don't raise rates and inflation starts rising up again, then the emperor has no clothes, right? We've just said till we're blue in the face that no, we're not moving that 2% arbitrary inflation target. It's got to go there. And so if it turns around and the Fed says, oh, well, no, we're not going to raise rates anyway, it will be, let's just say Fed credibility will be severely damaged.
Let's come back to the investor side in this. And one of the things, obviously, you've been doing well with is gold and silver. I mean, look, this is just off the top of my head. The gold was up, 27%, 27% this year. And let's look forward into 25. What are you looking there? I mean, is a repeat performance at some degree, possible at this point?
I think so. One of the reasons why gold, people say, oh, it's not really an inflation hedge. It doesn't correlate with CPI. Well, besides the fact that CPI is a flawed measure or mismeasure, people piling into gold has to do with their expectations. This is one of the few areas where I agree with the Fed that expectations do matter. If people think prices are going up, and I remember people feeling this way, I'm sure you do too, in the 70s, everybody knew everything was going to get more expensive. So you bought anything that was durable, wasn't going to go bad, whether it was cans of beans or gold, because you knew that prices were going up. If we get to that place, or people start fearing that and hedging that, you'll see gold move up before inflation. We saw this in 2020 before inflation finally moved up in 22. So the stickiness of the gold price, or gold dollar exchange rate, as I like to call it, in the face of lowering rates and all this stuff, and it says to me that some aspect or some element of the market is looking forward to what you and I are talking about. So I remain very bullish on gold this year. That said, we're not that far off of all-time nominal highs, right? So it's difficult to just say, yeah, it's going to double again, or another 27% from here takes us pretty close to a real all-time high. And anytime you look at the all-time high, it's hard to say, yeah, buy. It's time to be cautious when you're hitting highs, and time to buy when you're hitting lows. So I'm bullish. All the factors that were in gold's favor in 2024 remain in place for 2025. But I can't just say it's as dirt cheap as it was before, right? Silver typically underperforms gold at first. It does have its increased industrial aspect. I know people call me names when I say that, but I think this is a documentable fact. I'm not saying silver's not money, put away the rotten tomatoes. Yes, I get that silver's still money. It's still a monetary metal. You see it respond with gold on geopolitical news, for example. That's bad for copper, but good for gold. So I'm not saying silver's broken, but it is clearly responding to more information and to its industrial side as well. So if the American exceptionalism narrative falls apart faster than the money helicopters fly, understand the balance I'm saying here, you could see silver underperform gold, though I do think it'll do well.
Hmm.
Oddly enough, my favorite metal for the year on this basis is actually copper. I do think the money helicopters fly. I think that is inflationary. I think that will be good for anything real, including gold and silver. But since gold and silver are not coming off lows, whereas
Yes.
copper has retreated in a big way, I see more immediate upside on a percentage basis in copper than either of the monetary metals. But that doesn't mean run out and buy it today, folks. Remember, we got incoming Trump shocks. This will affect Dr. Copper and everything else industrial. You mentioned China before. Remember, the last time we had a step up in the tariff war or the tariffs with China under Trump, 2017, copper and most mining stocks took it on the chin because that was perceived as bad for China, bad for commodities demand. And even if it turns out to be a negotiating tactic or something in the end, I think investors will remember that. Commodities traders will remember that. And again, I'm in the inflation camp. I'm bullish on these things, but beware of the incoming Trump shock. You don't want to be picking up pennies in front of a possible steamroller there.
Coming back to China, because I mean, I'm looking at the consistent weakness coming out of their economic statistics, and a news story. It seems like every week they're trying to stimulate like crazy, but it doesn't seem to be having a lot of traction, at least so far. And that's what I'm looking at, the bigger picture for the commodity market. And copper is such a great example. And I love your point that obviously, if somebody is a short-term speculator, they're looking at different things. But on the long-term picture, the demand supply components still look very positive. But boy, that China is the fly in the ointment right now. I mean,
it's a huge question mark.
yeah.
I gotta say, it's far, it's a rare thing for me to compliment a communist anywhere, but I have to say that Beijing has demonstrated huge discipline in not just, totally opening the money floodgates and reigniting a property bubble that they
Yes.
had before. I mean, they know very well. This is a very painful recency bias on their part. So they know that it would be bad in the not very distant future if they reignite that property bubble. So it looks like they're trying really hard to stimulate this, that, and the other, everything except for that. Like even the latest real estate support that I saw was for existing housing, right? They want to help fill up all these ghost cities and all that. They don't want to build new ones. So it's commendable in a way. It makes sense. There's some sense of fiscal discipline there. On the other hand, it's not enough. You lock people down not just for a quarter or two like the West did, but for 2 years. That's going to leave scars. And the Chinese are already famous for saving, it's part of their culture. So you take people already disposed to be cautious and to save, not just go out and spend, right? And you lock them down for 2 years. Well, of course it's going to have an impact. And of course it's going to take a long time to get people to pry them out of their shell and come out and spend some more again. So I'm not surprised to see this trouble that they're having. I don't know how it goes in the end, in not the end, in the near term on the fight, but in the end, they're not going to just let it be. They will stimulate until they finally get the numbers they want, one way or the other. And probably that means they'll go too far. I mean, that's the way these things work. The one difference to remember, though, is that China has huge cash reserves, including dollars. They do have debt as well, but they don't have to print in order to stimulate, unlike the United States. So this puts them in an interesting situation. And if push comes to shove and they really, let's say their response to the tariffs is to devalue the yuan and really try to stimulate the market for internal demand, they could end up reigniting this bubble. We'll see. But it's a question mark that needs close watching for anybody in commodities.
Let's finish with another commodity, another China side of the story, and it's more than that. But you've done very well with uranium for your subscribers and the people who follow you. So let's talk uranium, because I'm looking at all the growth of nuclear in China right now. Well, that's inherent demand for uranium, and there's many other stories. We chronicle it on our, anytime I see somebody opening up a plant or doing more, investment, I listen to that as a uranium story. So your view on uranium, you still bullish on it? Is it a wait and see attitude?
No. I'm very bullish. And, if anything, this is a particularly opportune question right now because, in 2023, uranium doubled. We got a real hockey stick. By the way, that was my top call for the year, and I was right.
Mm-hmm.
But they went over $106, right? And it just, real hockey stick. So as we were saying earlier in this conversation, anything, goes vertical like that, you need to start thinking about possible corrections and so on, which I said for 2024, and people got mad at me, but here we are. But here's the thing, Mike, the uranium, the spot price corrected, the long-term price continues on an upward trend. That's the important one. So thing number one, long-term trend, unbroken, still going upwards, hadn't rolled over. The other thing is that this was so obvious, the demand story, like you're talking about with China building scores of reactors, adding more. It seems like every week there's a new announcement, but it's not just China, it's India, it's Europe, Eastern Europe in particular, despite the Germans, they have plans for dozens of these things. Even the US is restarting reactors and looking at that. And of course, Japan is restarting them as fast as they can. All of this is hugely bullish. And by the way, restarts need fuel now, not decades in the future. Mm-hmm. And that's not even to mention the small modular reactors and all this other stuff coming along. So the demand is there. The spot price has gone down, but the situation is so obvious that the stocks really hadn't corrected that much. So I was looking, for a correction back up the truck, like Doug Casey says, buy some more. And, the stocks didn't really get that much cheaper, but this has started to break down at the end of this last year. There are more interesting opportunities on the table now. It is very much a near-term goal of mine to look at what more I can add at I'm a value speculator, not a wild gambler. Mm-hmm. I want to look to see what opportunities there are. I think right now, this month, January 2025, is a good time, especially for anybody who missed uranium before, to have a due consideration for this space.
Good stuff. And people can get that, by the way. It's absolutely free. You can go and get the due diligence reports. All you do is you go to independentspeculator.com. They need an email address, for goodness sakes. They got to know where to send it. But that's where it is. It's independentspeculator.com. It's absolutely free. And to follow Lobo's, train of thought as he goes through this kind of year within that. And I know a lot of people were waiting to hear what you had to say about uranium, so I've delivered on that score. Thank you. But I look forward to a great year and hope we can visit again in the near future.
Thank you, Mike, and to the audience. I'm sincerely wishing you a healthy, wealthy 2025.